Boom, we are recording. Hello, everyone. Thank you for being here. Welcome to Security Tokens Uncensored, episode 2. I am Alon Goren, and with me today is Ami Ben David, who I teased on episode 0 and I said I would have on the show. So I'm excited to have some listener questions and talk to who some call the Godfather of Security Tokens, who it's a term that Ami is very comfortable with. I talked to him before the show, and he actually told me he didn't share the post because I called him the Godfather of Security Tokens in the post. So I'm happy to have him here. He's a humble guy, and he really is one of the earliest security token pioneers. And so Ami, thank you for being here. Let's start with SPiCEVC, but let's start why you got into the space to begin with, and why SPiCEVC exists.
Yes, hi Alon. Yeah, yeah, the story of SPiCEVC started when ICOs were kind of ruling the day, and actually only started. And we were talking about starting a fund, the three founders of SPiCEVC, Talia Yashiv and Carlos Domingo and myself, and we were talking about starting the fund, and we got very excited about the blockchain. We saw the blockchain coming. We wanted to do a tokenized fund, and we started looking around, and we were told that it couldn't be done because at the time there were only utility tokens, and a fund is a security by definition.
Yeah.
I mean, people give you money, you're supposed to give them back more. That's the definition of a security. You can't call it a utility. So we were almost forced into the security token space by our kind of desire to do a tokenized fund. And we started building everything around it, the legal infrastructure to understand how it's going to work. And then we were looking for a platform technology, and there was none in the market. So we brought together also Shai Finkelstein, who joined us and worked with us as a CTO and helped us build this platform together with us. So the four of us basically built a platform. And we said to the world, this is it, Spicy, you can invest in Spice through this platform. And it turned out that the platform itself was also very interesting. So we spun it out to a separate company, which is called Securitized. Securitized became the first portfolio company of Spice. But more importantly for us as Spice, we realized that security token is a much bigger story than ICOs ever were or could be. That it's about not just funds, it's about tokenizing and bringing the digitization to ownership in general. So that was a realization that we started Spice with almost.
Yeah, so from the very, very beginning of Spice, I mean, I know from having been a part of it a couple of times now, but particularly one time I spent a lot of time in just the creation of a fund. In general, which isn't an easy and simple process to begin with. What kind of stuff made what kind of stuff? And I know you were early on, so there's no blueprint. But what was the really hard part that tokenizing brought to the table? How did it differentiate creating a fund?
We were slightly lucky in that we were not completely the first. There was Blockchain Capital who came before us, and they built a tokenized fund. It wasn't exactly what we wanted to build. We wanted it's an evergreen fund, and we want to build a regular VC fund. So we had to iterate and improve on top of that. But I'd say the most important aspect of a tokenized fund is education. We're not doing anything new in terms of the law itself, in terms of regulation. Yeah. We're just using them in a different way, in a digital format. We are adhering to all the existing rules and regulation. But the market has to go through an education process where maybe a year and a half ago, there were 4 or 5 companies in the space talking about security token. Nobody else knew what it was, and everybody thought that utility tokens are the future. But fast forward a year and a half, I think the market is talking slightly differently now. So, and the SEC pushed a lot of people towards us. So we're seeing the market starting to understand it, and we're seeing the market shifting. Not as fast as maybe we would like it to, but the market is definitely shifting towards the security tokens in a big way.
Yeah, so you guys built that technology platform to enable it, and it spun out to securitize. What kind of stuff? So when you went out as a security token fund, I know that when you go out as a fund and you find a potential investor, you send them the paperwork, or your fund administrator sends them the paperwork. They sign it. They wire money to an account. Was the process similar? Did a lot of people invest with Bitcoin, or how did that work?
Actually, it was very, very similar.
Yeah.
We had a memorandum which we sent to people. Most people invested fiat. Bitcoin is not suitable for investment in funds, in my view.
Yeah.
It's too volatile. Same for Ethereum. So until we have stable coins or something similar that people can invest in and get the benefits of both. In stable coins, you get the benefits of both. You can have immediate transactions, and you can have even atomic swaps with stable coins. But at the time, these didn't exist. So we had fiat, and most people really invested in fiat. So I would say that beyond the fact that tokenizing it allowed us to really feel the market and understand it with our own hands, and really get dirty and doing it. The fund is a regular fund. I mean, we're investing in companies. A vast majority of investments, almost all of our investments are in equity. And we will be judged by the returns that we bring to our investors on the investments that we made. We have, I think, around 11 investments already on our website that you can see. There are some others that we're working on. And this is really what's important about the fund. Is it doing well or not? Which is, in our case, what appears in the NAV of the fund.
Is there an added pressure? Because, normally a seed stage fund, and I know that you guys are some of the earliest investors in the companies you're in. So normally a seed stage fund isn't really returning money to the investors for 5, 7, 10 years, right? So is there this added value to, or added pressure to, maybe make some short-term plays, so that because it's technically a liquid product, to do something? Or is the NAV in itself, because even if a seed stage fund, I think I'm partly answering the question myself, but is it because the NAV itself grows regardless if there's an exit, that is enough?
That's correct. The NAV is a reflection of the value, a paper-based reflection of the value of the investment that we made, and it's being, we use EY for that, and it's very conservative. So it basically usually goes on the last valuation.
So the last time a company raises a round of funding, you can calculate the value of that investment.
Yes, and then some companies have done better since the last valuation. Some companies may have done not so great after the last valuation, but maybe they will improve. A lot of things can change, but the NAV will give people a sense of what the fund is worth. And I don't think we're being pressured into short-term decisions, because people know we're investing seed. These are long-term investments, and if we're lucky and some of our companies exit early, then boom, that will be great. But it's not something we're going after. If you have a company that can build value and become $1 billion company, and it will take 7 years, then obviously we prefer that over having a short-term gain in a small startup.
Sure. And if there is an exit early on, how is there a process of issuing dividends or returns to the investors like a normal seed stage fund, or is the money then go back to the fund and reflected in the NAV? Because is it sort of evergreen in that sense, or is it more like
it's a regular fund? So we return the money to the investors. The way that we do it is we do a buyback, which is automatic buyback from all the investors pro rata. So in fact, if you have 10% of the tokens of the fund and 10%, you will get 10% of the net revenues out of an exit. So we haven't announced any exit yet, but it's all pretty clearly laid out in the memorandum. We almost try to make it as similar as possible to a regular VC fund, in the way that we collect the money, in the way that we return the money, in the way that we invest in the company. Because I think 3 or 4 years from now, whether the equity or the LP interest in the fund is tokenized or not is going to be, it's not going to be important. in terms of how the fund is evaluated, but it is going to be important in terms of having some liquidity and other benefits in the tokenized version. But all the advantages of a fund will still be there. I see only upside to tokenizing. Now,
Yeah.
we are the first or one of the very, very first to do so. We're people still are not comfortable, or were not comfortable a few months ago with the concept, but every month I see people getting more and more comfortable with it, and I think that the institutional investors are coming as well. So I think that within a few months, and then maybe a few short years, people will just regard the tokenized fund and regular fund in the same way, only that the tokenized fund is less of a long-term commitment like it was. And this is one of the big advantages of tokenizing, that it's not anymore a 7 to 10 years commitment, but it's a shorter commitment. And if you want to find a buyer, you can find a buyer. And if you want to do a transaction, it's literally seconds. It doesn't require lawyers. It doesn't require long discussions and so on. A transaction can literally take seconds. And when I did the first transaction in a token of SPiCE, it actually felt different.
Yeah. Well, it's what I was thinking is, when I've talked to people about investment opportunities and tokenized investment opportunities, I think that some companies or the issuers are approaching it wrong because they're leading with the fact that it's tokenized as if that's the reason to invest in something. And it's actually backwards. The investment opportunity has to be a good one. It has to stand alone. And then I think that the tokenization and the technology is now just an added value, and at worst, bells and whistles on something, but at best, it's an opportunity to create liquidity in a deal that you normally would not have had that kind of liquidity.
Yeah, this is the journey that we've gone through. Our first closing in March of last year, before the closing, we did talk a lot about the fact that the fund is tokenized, but now for me, the fact that the fund is tokenized is just a way to show that we understand the market, and we actually experienced it with our own hands, so we understand the market that we invest in. But actually, what's important for people who are coming for our second closing now is what the portfolio looks like. So, so you look at a portfolio and you see companies that are doing, really well. So we talked about Securitize. We have a company called Rocks, which is doing really, really well. We just invested in Archux, which is an exchange out of London for security token targeted at institutional investors. We believe this market of security token is going to grow. And the fact that we tokenize our own fund gives us the expertise and the access to invest in the infrastructure of this space. And that's what our portfolio looks like. So if you look at our portfolio, you can say, well, if I believe that security token is the future, these guys tokenize themselves so they know what they're talking about, but that's not as important as the fact that 11 of their investments are actually in this area that's going to grow so much over the next few years. And if you believe in the area, if you believe in the space, then going to SPiCE can give you an exposure to that space. It's really about the asset rather than the tokenization, which is technical.
Yeah. So what I was going to ask before I have a good segue into another topic, but one quick thing I wanted to ask. All of your companies are in this space, either a blockchain or security token type of how many of them actually are creating their own security tokens versus just equity investments?
So most of them are the infrastructure. Most of them are the infrastructure for security tokens, and most of them are early stage. So they're not tokenized yet, that they have equity. Some of them, like Archux, are talking about doing a security token in the future, as well as other companies in the portfolio. But this will come in the natural progression of things.
Yeah, I think it makes a lot of sense for a lot of companies to even at this stage, not purposely delay tokenization, but definitely have plans to tokenize and not necessarily jump into it, because it doesn't need to be the first step of the process. I mean,
So we have a company, for example, we invested called InvestorCrowd, and that's a company. InvestorCrowd is coming out of Singapore. So they've been in the space for a while. They're already working on some tokenization projects and so on, and they will tokenize themselves, when the time is right for them, when they're in the right stage to tokenize and to bring in investors, because it's really tokenization. People are becoming more and more. It becomes more clear to people that tokenization is going to just be a digital version of an analog thing. It will have a lot of advantages, but in the end, it's all about the asset underneath the security.
1000%. So speaking of that underlying asset and kind of going from your experience of doing it yourself and going through the whole process yourself, and then you know, spinning off Securitize and having them do their thing, and I know they're living, you know, sort of their own life separately now, but we, you know, you now are one of the founders of and launching the Ownera Foundation, and full disclosure, I'm a part of that as well. So so you know, just so everyone knows. But talk about that. You know, one thing we've talked about a lot is how do you really, where does the asset and the blockchain work together, right? So you do have the SPiCEVC token, but the actual investment is still a traditional piece of paper, correct? So so we talk about the asset, how, you know, and the future, we believe, and I believe, and we will dive in, get it in your words, is the actual underlying layer being able to understand the regulation, understand who is participating, understand what the investment opportunity is, and know who and what can participate automatically versus you know, having to have third-party service providers check on an individual basis. They will have to do certain parts of it, and we can dive into it. But the first part is what we talk about with the Ownera Foundation as the KYA, the Know Your Asset. So where do you think the future is? Because you were great in predicting the future until now. We are now. What do you believe the future will go to? And I dropped a few, you know, hints there, but I want it in your words.
Well, I think that if you look at the security token space right now, there are two almost extreme views, and one of them I would put maybe project like Ravencoin, and on the other extreme you put projects like the Ownera Foundation. And the difference between the two approaches, and both of them could be valid, but the difference is that one approach sees the token as just something that you trade. The token itself is not the value. The value is outside the blockchain. The token can trade, and then in some cases there's, you know, in Ravencoin currently there's no limitation whatsoever, so it's not really a security token platform, but they're talking about adding some capabilities in the future which will allow regulation compliance. So when that comes, but still the token is just a token. It moves from one end to the other, but it doesn't carry any value with it. And the value is external to the token. Somebody said that if you have that token, then you're entitled to whatever a document outside the so I would say out of the security aspect there, maybe 20%, 10% is on chain, and everything else is on proprietary platform outside. And that's one approach, which is, I would say, potentially easier to create, and that's why Ravencoin was pretty quick into the market. The other approach, which I believe is actually the right approach, is to say that this is a big problem, big potential problem, because the problem with tokens is that they move between one end and the other. And it's fine when you're doing a primary token and somebody wants to buy directly from the seller and they don't have any documents or anything like that. They can go to the seller and say, hey, please send me this document. But then the token will start to move between hands. And when the token move between hands, the third token buyer or the fifth token buyer or the 10th token buyer, they will have to be detectives to know what they're actually buying. And you can already see it in the security token market yourself today. It's starting to be a little bit of a problem, and we're not feeling it yet because we're in the primary stage. But when you're going to a little bit in the future, it is going to be a problem. And the biggest problem is that none of it is in the blockchain, and there's no game mechanic, or nobody's incentivized to make sure that whatever the token says about the external property is actually true. There's no connection.
I mean, so, right now it's mostly ERC20 tokens, and they're pointing at a PPM somewhere, which can be modified very easily by the company legally, but still offline or somewhere that's not where you can't track changes very easily.
So let me put it this way to you, Alon.
Yeah.
Those platforms were just built to do that this way. They're not built for securities or for real world securities. So that's the entire platform is just built for that. So I'll give you a simple example. If I give you 10 ETH now, then all the miners do the work or will put a stake at some point or whatever, and they make sure that you have 10 ETH and I don't have 2 ETH. Okay.
Yeah.
But if I give you 10 tokens of my usual example is if I give you 10 tokens of the Brooklyn Bridge, okay, all the miners are very happy because you have the Brooklyn Bridge.
Yeah.
But it wasn't mine to sell in the first place. So it doesn't make you the Brooklyn Bridge owner. And just to prove the point, I went ahead and bought the Brooklyn Bridge on Ravencoin, and I'm now the owner of Brooklyn Bridge on Ravencoin. And I can sell it to anybody who wants to buy Brooklyn Bridge on Ravencoin.
I'm still waiting on mine. I sent you a cashier's check in the mail. I'm waiting.
Of course. You're never going to
get the beginning. I lost money at the beginning days of eBay because I bought something and I went to the post office and bought a cashier's check or whatever it's called. And I sent somebody like $60-something to me when at the early days I was a teenager. And it was a hard hit. So I can see this going many ways.
Yes. So my view was that if we want security tokens to be successful in the market, we need to create a situation where if somebody buys a security token, and I'm talking specifically about institutions, if they buy a security token online, they can know for sure exactly what the rights that they have. So in order to ensure that people actually trust security tokens and not find themselves in a situation where they bought a security token and then it's not exactly what they thought it was because the information about it is all over the place. We designed a model that has 3 layers or three parts. The first part is what you call KYA. KYA is the concept of know your asset. The same way that KYC talks about the identity of a person, KYA is about the identity of an asset. KYA for me is a set of documents, a folder of documents that includes everything you need to know as a token holder about your rights in the token. And it's immutable, so nobody can change it. Immutable in the blockchain sense of the world. So nobody can change it overnight without the 4th seller of the token selling it to the 5th, and the 5th person doesn't know that it was changed overnight. So it's there. It keeps the history. It keeps all the revisions. It's secure. It's privacy enabled, and it's there. So if the token changes hands, the 5th hand that's buying it can just look at the browser, open the KYA, and see all the information. So that's the first layer. The first layer is KYA, and I know that a lot of people say that can be done off blockchain as well. It can be done off blockchain, but currently there's no. The market has not agreed what KYA looks like in different asset classes and so on. And this is why we started talking to people like the accounting firms and so on, and the big banks, investment banks, to see what should be included in a KYA, so that if you attach it to a token, you can look at the token and get everything you need to know about it. So that's the first level, which is the KYA. It's just the definition of the information required.
A standard.
But the standard. But the second layer on top of that is to say, well, can somebody do their own KYC? Can somebody come in and say, I'm not a criminal. I'm not a money launderer. I didn't do money laundering with the money that I'm just going to give you. It can't be done. You need a trusted entity. Somebody else, they can provide the passport. Somebody else needs to actually look at it.
Verify.
And verify it. The same way for me in terms of the assets, you need trusted entities to look at the asset, to look at the KYA, and to say, well, these documents are legit. These are actual people that they own this asset, and this asset really represents the rights that the tokens will receive, and so on. And these entities who are in the middle are, they're important. They're there for a reason. The blockchain movement has a tendency to want to remove all the intermediaries, and that's fine. But this verification model, I liken it a lot to the work the miner is doing in Ethereum. The miners in Ethereum are doing work to make sure that tokens move from one hand to the other. I think that in a security token environment, there should be people equivalent to the miners that do work to make sure that really what the token is, what it says it is, and even stake the reputation on top of it.
Exactly. I think the reputation is the important part.
Yeah, so you have work, you have stake. These are very blockchain terms. And then these people can actually go out and distribute it because say, okay, I did the work, I verified the asset. So you can have a situation where people can start buying security token knowing exactly what they're buying because they can see all the information in the KYA. They can see who is a third-party verifier that actually verified the KYA, and they can know that nothing has been changed, there's no cheating, and if their rights are denied, they can go and claim them because they have all the proof that it's theirs. And it doesn't matter if they're the primary buyer or the secondary buyer or the 10th buyer or the 1000th buyer, they still have this level of security. Whereas in platforms like Ravencoin, I'm afraid there may be a situation where people will buy tokens down the line and they will find out that the underlying is not what they were told, or it's completely different.
Or even the current solutions, even forget about Ravencoin, is just look at Ethereum and somebody can, it defies the sort of the principles and the spirit of the whole point of this, right? It's supposed to be transparent and honest. There are problems in the real world of startups or companies changing their documentation and investors not really realizing that they get diluted or something happens, right? That shouldn't be possible in this world because the whole purpose of this world is to be transparent and honest and be able to see and find all the information. So where I was going is, instead of this spirit of, hey, let's disintermediate everything, which I'm a huge fan of in many respects, and why I'm a fan of Bitcoin and got into this space to begin with, I almost feel like instead of completely cutting them out, which is not really realistic, instead we're forcing them into our framework and giving them an opportunity to participate at what they do best. We're gonna now force them to be transparent so that the banks can't play games on us, but we're also forcing them to verify the information that only they can. Sometimes they're legally obligated to verify and stuff. Right?
We're talking about banks, but it's not just banks. It's banks, broker dealers, it's new entrants into the market. Anybody that wants to provide a service should be able to come in, prove that they're a legit entity, and start competing to provide the services. But when somebody is buying a security token, my belief is that they should be getting something that is solid. When you're buying a security token, your rights in the underlying asset should be as strong as your rights when you buy Bitcoin to the value that the Bitcoin provides. It should be really, really solid. It shouldn't be something that says, you have the token, that's what we promise you. What the token actually represents, go somewhere else. Go search somebody's website.
There is a concept, and I actually brought this up in a call earlier because somebody asked me about the entertainment sector. Because I worked at IMDb and they somehow connected me, even though I was a product person and I was working on video, so I wasn't really in this world. But there's a concept in the entertainment world when they're negotiating contracts called monkey points. Because people in that world, sometimes they're an actor, an actress, or a producer, and they want points on a film or on a show. And the creative accounting in that industry basically will almost always, on monkey points deals, find a way to not actually give you what you were promised. They go, well, I know Forrest Gump made $1 bazillion, but we lost money on that one. I'm sorry, you didn't actually get anything. And I have a feeling that if it's not transparent and honest and verified correctly by trusted financial institutions, those types of deals will start to happen. You have a token that might be worth something, but with creative accounting, you'd be like, oh yes, they're common shares in this company, but we also had a preferred investor that got, a Forex liquidity preference and all the money went to them. Sorry, token holders.
One of the reasons that I'm talking so much about the solidity of the security token and how security token must carry its value with you wherever it goes, comes from the fact that I think that the industry is now realizing that the target for security token is, initially at least, is not in the crowd. This entire industry started as an evolution of ICO. So people initially kind of thought that we're going to the masses, security tokens will go to the crowd. In the same way that ICO went to a crowd of crypto investors, we'll go to a crowd. And I think that will come in the future when security tokens and digital securities are just securities, it will go to the crowd too. And I'm already seeing some people like INX, one of our investment, one of our portfolio company, they're doing a token that will go to the public, will go retail. There will be some of those, obviously, but this industry is not about going to the masses at this stage. This industry is about getting institutional investors to participate. That's what it's about right now. And in order to get institutional investors to participate, you have to make them understand, you have to make them trust who they're buying from and what they're buying, and have to make sure that it can't go wrong in any way. So all these things about, let's hope that something will be fine, it's not good enough. Now, in some asset classes, regulations already dictate the information that you have to provide. Yeah, and that's fine. But security tokens are already going to places where there's no clear regulation what you have to. On Reg D, there's no clear regulation of exactly what you have to provide to your investors, and when you have to provide it and what disclosures look like. It's much less structured. Now, if you want to tokenize that, and you don't have the regulation that forces you to do that, if you don't have a framework of KYA and a framework of validators that actually get paid to validate the KYA and then distribute it, if you don't have that, you will not have their trust. You will not have you will not have them come. You will have them in some cases, in isolated cases, they will come. Yeah. But if you want them to come in mass, if you want them to come and really participate in this environment, I think that we have to give them a solid solution and not something that
And that solid solution should include the requirements they normally ask for in an investment opportunity. When an institution does come in, if they came to SPiCE and it wasn't a tokenized fund, let's say you were just doing a normal venture fund and a large financial institution wanted to participate, they would ask for certain rights if you didn't already include it in the PPM. In a specific kind of deal like this, they may not, they may not have that luxury because they're getting the same kind of tokens everyone else is. Maybe they could do some kind of side pocket or something, but that defies the spirit of this thing. So if the standard terms and the standard quality is institutional quality terms and deals, then I think everyone now benefits because everyone gets those rights, and the institutions are willing to play ball. And they need those verification tools. They need to know that every investor had KYC, every asset is verified and has KYA. So what I would like to kind of, it's not a transition completely out of this, but what I would like to talk about is, aside from KYA, well, you talked about the institutions, the banks, the verifiers continually verifying these assets. But there's other elements in the system that maybe are more outside of the control of the average individuals and issuers, which is regulations, KYC requirements, things like that, and how a concept like Ownera and the Ownera Foundation brings to the table is sort of continually incentivizing and creating almost this new economy within it of those verifiers. So what happens, for example, if I live in Israel versus living in London versus living in New York versus living in Uganda, and I want to participate, but there's outside regulations dictating if the deal is in Uganda or the deal is in London or the deal is in Tel Aviv or the deal is in New York. There's different regulations per deal. There's different regulations per investor, and how now a base layer can deal with that, right?
Yeah, I think that unlike the concept of having all the information and the KYA and the verification, which is an inherent new thing about the Ownera Foundation and about this concept of how things can be more solid to the level that institutional investors can go into, I see the regulation part as more of a I would say technical solution. And today, the way that regulations are done in the current blockchains that were not designed for this is very cumbersome. You have to do it again and again in every token. You have to redeploy all the smart contracts. It's very, very complicated. And there are multiple smart security token protocols that are trying to do the same thing. It is very, very complicated. The idea of how we wanted to tackle that when we were designing a new use case specific blockchain was to say, let's open source it. Let's have something that is like, you can think about it as an app store for regulations, okay? And in it, you'll have the regulation in the US and the Reg D and Reg S, and you have the regulation in England, the regulation in Israel, and the regulation in Uganda. And if there isn't in the App Store a regulation for Uganda thing, then the regulator in Uganda can write it, or open source developers in Uganda can actually write it and add it to this App Store. Okay, and when it's there, every issuer that issues a token can come in and say, I want to pick, I want to be compliant with this, 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 and this, okay? And they chose 3 regulations from the App Store, and they just attach them to their token, and that's all they have to do. And from that moment on, this token is compatible with these regulations to the point that if the regulation changes, the open source developers can come in and change it, and then the token will automatically be compatible. But I keep saying compatible, but that's not what I mean. What I mean is enforcing. The security tokens, people don't get it. People are, this industry started from ICOs, which did not have any regulation, and moved to STOs. STOs are not just regulation compatible. STOs, if done properly, they're regulation enforcing. If somebody goes to a platform like I described and chose from the App Store of the regulations, 5 different regulations, the platform will enforce these regulations. Nobody can actually break the law, even if they wanted to. And this is a beautiful thing for the, that's why
using your IP address to participate in a token sale.
So because of that, I think that regulators will come to actually look at this piece of code. And I see a day where the regulator will look at the piece of code. Initially, it will probably be law firms who will give their name to an app like that, a regulation app, and trust it, and then maybe they get some revenue for that. But I see at some point regulators coming in and giving their okay to a piece of code that is enforcing regulation, because that will mean that they don't have to start chasing after cheaters, because nobody can cheat because the code is well written. And I've actually checked this, and there is precedent for regulator looking at code. And you can see that in the aviation world, where if you want to put in new software into an airplane, it needs to be regulated. And the regulators actually give regulation approval to code. It can be done also in security token and digital securities. Once we get to that point, the SEC will be in a much better position than they are today. And I think that they should adopt it. It's not going to happen tomorrow, obviously, but in time it will.
Yeah, I mean, I love, I love the fact that there's the trusted sources to verify the particular asset, and then a not exactly third party, but within the system, a role for these modules, or like you said, an app store for each specific jurisdiction to sort of enforce the rules and laws, because it now, although the spirit of what we originally went to with the ICO world and crypto in general about being worldwide and borderless, it goes in a way against that. What it does, though, is it does create an opportunity for, if you are in a specific jurisdiction, if you make a certain amount of money, because in the US we have the credit industrial laws. If you are whatever you are, you can there will almost be a catered environment just for you. So I see a future, and I know this is steps ahead of, my cousin in Israel logging in and seeing the deals that they can participate in without the disappointment of seeing the deals that they're not allowed to participate in, versus me logging in and seeing the deals I can and can't participate in, and different people around the world being able to transfer them with each other based on if they're allowed to or not.
I almost think this is the only way to scale. When we're talking about, we have to understand what we're talking about as a potential. And I don't want to hype anything. I don't like hyping. It's not in my nature. But the concept of digital securities is you take securities and make them digital. And I actually like the new term smart securities, because they're not just digital. They have code in them that can do smart things. It's like a smartphone versus an old phone. So it's smart securities, if we call them that way. The future of smart securities is to replace securities. It will just be securities. All securities will be digital and smart, because today, there are a bazillion ledgers that keep ownership. In the future, there'll be much less. It will be all blockchain. optimized. But in order to get to that point, you need a very slick network. You need a platform where ownership can be managed. And in order to build a platform like that, you have to rethink. After doing it for a year and a half, I had to rethink what it would look like in order to scale. And scaling is, people, when I talk about scale, people think I'm talking about transaction numbers. Yeah. I'm not talking about transaction number. I'm talking about scalability in terms of the social element of scalability, the ability of investors, initially institutional investors, and then family offices, and then the rest of the market. Then it will get to the crowd, okay? But the market has to adopt this new technology of smart securities at scale, at a very large scale. So in order to do that, you need something that was built specifically to do that. That's what I believe.
I agree, and I think the major opportunity to not totally hype, but to throw just some crazy numbers out there is that there is, if we truly believe, and I believe it, I know you believe it, and a lot of our listeners believe it, if we truly believe that blockchain will make the process better, will streamline it, will make things more efficient, will make things more cost effective, and all of those things that it has the potential to do. If we truly believe that, then the first real step will not be startups and individual real estate deals or funds tokenizing, which is exciting and which is a part of the capital formation process, the capital raise process, but it will be taking existing assets and bringing them to this system. And things like I had an old deck from my previous company that showed the alternative investment market in the United States is $7 trillion a year by itself. That doesn't count the quadrillions or whatever people are talking about for the security token space. But just think about that one thing and going, you know what, if somebody decided to start taking some of those assets, if a Guggenheim decides to take one of their $1 billion funds and tokenize it because the technology just streamlines it and it creates more access and opportunities, or creates that little bit of extra liquidity, that's enough to be really, really insanely significant. I mean, when we talked to David Wield, it wasn't on this show, but he mentioned, and I'll paraphrase so the numbers might not be exact, but when we talked to David Wield and he talked about the difference between quarterly calculating interest in the bond market and monthly calculations of interest in the bond market, those bonds trade at I think it was 3 or 5% premium, even if it was a 1% premium. What's interesting is that with technology, we could be calculating interest by the minute, right? It probably doesn't make sense, but you probably do daily or weekly versus monthly or quarterly. And if it's transferable on a open exchange in the same way that a public stock might be, but you're talking about a private asset that normally takes legal teams and all sorts of documentation. If you can just streamline something, all of a sudden these assets will trade at a premium, or they should. Or if it's just the norm, it's just at minimum trades efficiently. And being more efficient and creating a more efficient market and 24/7 markets and international markets, all of a sudden we're going to create a lot of exciting opportunities. And
I think that when I hear you describe it, it's funny. I look at this market and I try to take a step back, and I see all the cycles of innovation happening over the course of a couple of years, and it's actually very, very interesting. So when we started, it was like, what are you talking about? The security tokens, everything is utility tokens, it's not going to happen, etc. And then we came in a few months later, and it was the opposite. People were, security token are the future. Everything is going to be security token. It's going to be the thing of 2019. And then a few months later, people come in and say, "Oh, actually, it's not moving as fast as we thought. It's all garbage. It's not worth anything. Those tokens are not trading. Nobody wants them," and so on. And then people are saying, "Hey, but actually, the potential is huge," and you can see these waves of the innovation happening. So I think the stage we're in now is a stage where is just before the kind of people are starting to realize the big potential the big potential in private market where everything is analog and we're just moving to digital. And just by doing that, moving analog ownership to digital ownership has just tremendous opportunities in it. And later in the public market as well. If anybody that knows how settlement work in the public market knows that this is something that was created as patchwork on top of patchwork over years of things of how to do settlement, and there are multiple ledger and they settle over days. It's a disaster. And
I worked at a bank, even just as a teller, fresh out of high school. And I still, that was 20 years ago. I still go into the same bank and I have an account there and I look over their shoulder. They're still using the same systems. And back then, I remember laughing at how terrible and outdated it was. I used to be able to, while working as a teller, VPN into my computer at home to work on other stuff while I was sitting there. And think about the security implications and the security risks, let alone the just old, outdated technology that was bad 20 years ago.
Anybody that's been to spent a minute in Wall Street or in the city in London knows that in most of these markets, the ledgers and the settlement mechanism we have now is outdated, can hardly scale and so on. And digitizing everything on a single or a few kind of joint shared ledgers is a much better way. It has, the way I like to say it, long terms is only upside. Even midterm there's only upside. Short terms there's some pains of learning, but this is where I think we are now at the phase where people are looking at the security tokens. There are just a few of them outside. The exchanges are not deployed yet. Like our investment in Archax is just now getting their licenses to be an exchange and so on. So it takes time. But everybody that we talk to in the industry, and I'm now most interested in the investment, in the institutional investor community, and the investment bankers and broker dealers. That's the people that I'm talking to. Everybody in that environment at a higher level understand that this is the future, and almost ignore what we're seeing right now as the early birth pains of this industry. So looking at Ownera is trying to do it. Ownera Foundation is trying to design it properly and do it right, as opposed to just taking a blockchain and say, okay, this will be a security token blockchain, as well as being 1,000 other things.
Yeah, well, I think when you talk about the adoption as well, and you talk about institutions, I think we do have a road ahead of us. But we go back again. Amazon started with books. Then it was movies, then it was everything else. And there was this process. And I talked about sending a cashier's check to somebody to buy something on eBay, and then PayPal, and that whole process. And that happened, over 10, 15 years. And now we saw crowdfunding come in, and took 3-4 years before now we're getting into something more usable. And I think that the process each time happens faster and faster. Think about this, less than 10 years ago, maybe 8 years ago, whenever it was, I worked for a company called Without a Box, where you submitted your film to film festivals. And certain film festivals were exclusive. So like if you wanted to submit to Sundance, you had to submit through Without a Box. And they were owned by IMDb. And so it was owned by Amazon technically. So when you submitted your film to film festival, just a few years ago, you had to send a DVD in the mail to a company. They would copy the DVD to send to each film festival. Then finally, we had a process to upload the film. It would take people 2 or 3 days sometimes because of their connections at home being bad or disconnecting. Sometimes producers would bring their whole boxes, their computers, to our office to help them submit their films to Sundance once you were able to upload the HD. Then there was IMDb theaters, where you could watch some of the movies on IMDb once it came out. That eventually became Amazon Video on Demand, and that became what Amazon is today and what Netflix is today. Just a few years ago, that wasn't even possible. Almost every single one of us didn't have the bandwidth at home to watch a movie on our computers, let alone stream it to the TV. And now there's not one of us that doesn't do that. And so we went 10, 15 years ago, you'd still try to convince my mom to buy something on the internet, and she thought I was crazy. Now there's not one person in the modern world that we talk to that doesn't do that. So,
but I think part of the frustration that I'm seeing with some people that come from the crypto world
Sure.
And they think that, oh, we'll just fork Bitcoin and we'll add some asset names, and people will use that as a security token platforms. They come from, a lot of them, not all of them, some of them come from the technology world. And once they have a technology solution, in their eyes, the problem is solved. But it's not. If you're talking about a pension fund, right? These guys, they're in charge of our pensions. They're in charge of money. They cannot afford to lose it. They wouldn't even look at the new market until it's like 10 years established, because they cannot afford any risk whatsoever to even think about it. So yes, they will initially maybe try and get some exposure, but even if you have the technology solution, it will take a lot of time. You need much more than the technology solution. You need the trust solution. You need the social scalability. You need the,
and it needs to be legal.
Saying on the technical side, I had this discussion with somebody on Twitter, and a lot of them are anonymous. I don't know who I'm talking to. I don't know how serious they are. But I had this discussion with him, and he found a technical solution for how you can prove that a token belongs to somebody by posting something on the website.
Some metadata.
Some metadata. And technically it's a good solution.
Sure.
The difference between this and an investor from an institutional investor trusting and relying on a platform because somebody published in their website, a string is like the difference between me and landing on the moon tomorrow. It's not a technical problem. The technology will help solve it, but we need to digest these things into solutions that are much more friendly to these people who are going to be using them eventually in the end. And it has to be much more resilient. It has to be such that nobody can replicate the website and create something that and do a same unique name, just add change the capital I with an L and masquerade to be you. All of these things that we're seeing on Telegram and on ICO, they will not cut it in the security token world if we want to scale. We need robust, serious solutions. So at some point, sometimes I'm arguing with people on Twitter on things, but people coming from crypto, especially the technical people, having a hard time understanding why something that is technically possible is not happening and materializing in the real world the next day.
It's I get it. It kind of hits close to home for me, because about 10 years ago when I first launched Invested In, we had no idea that raising money on the internet the way we really wanted to was illegal. And we were just idealistic techies, working at MySpace or whatever, going, why can't we use the same technology that we share Farmville to share a deal? Like, it doesn't make sense. And then once we find out it's illegal, then we say it's un-American. We still try to find ways to do it. But you're absolutely right. The technical part is not the problem. What they're suggesting is exactly the same thing as verifying to Google that I own a domain name to get the Google Analytics for it. I put a string of characters somewhere in the footer or hidden from view, but it's there. They verify. But that doesn't necessarily mean that a bit of social engineering can't copy that, right? I could very easily work for GoDaddy and put that same string of characters on any website on the internet after I went and got a $15 an hour job to work in a call center, or I could work for AT&T and port your phone. So having these large financial institutions verify all of the details, not just I own the domain name or I own, there's so much more to it as well. But you're right, I think.
But these are, I think, the two approaches. And I think that each one of the approaches, the kind of naive approach that says if it's technically possible, it will be done. And the more kind of approach that says no, but let's actually look at the fiduciary duties and the business needs of people, and build a platform that is robust and scalable to the trillions of dollars and so on. I think those two approaches have something to give. Both of them have value. It's just two different parallel worlds sometimes, and seeing them argue with each other on Twitter can be sometimes funny.
Yeah, I joked. I took it was a long weekend for us here in the States, and my kids were off school yesterday and stuff. So I tried to be home and as present as possible, and I tried to not be on Twitter. And this morning I had 100 alerts on one thread And it was a great thread because both sides had very important points, but but I think that
they look at the world from very different viewpoints.
Approaches, yes.
Approaches, and for each one of them from their viewpoint, they make total sense.
Yeah, they absolutely do. And so, though I think we get back to the same question, actually one of the most asked questions ahead of time, and we didn't even get to the user questions, but I asked them sort of as in conversation, we've got to wrap up and say, but one of the main questions obviously were, when are institutions going to get into the space? And we kind of answered that. But I think that that's also the difference between the two viewpoints. One satisfies the requirements of a techie who goes, well, we verified it, right? And one approach, I think, will instill confidence in a existing 7 trillion US market, but every other kind of asset and thing that can also, you know, be applied to, right? So do you feel that that's the main difference? And then, yeah, let's sort of end with that.
Yes, I think this is the difference in approach. The difference in approach that you know, I think, you know, where the market is going to go eventually is to a platform where, you know, if I have to put my finger on difference, is that the tokens will not be detached from the value. The tokens will be connected to the value, and the connection to the value will be verified by entities that are trusted, and the distribution will be done by entities that are trusted, so that anybody that buys a token, that is a security token, will know exactly what they're getting, and nobody can cheat them. And it doesn't matter if they bought it from the primary seller, or they bought it after 10 hand changes. If they bought it at 10 a.m. in the 10th country on the 5th exchange, in Saturday night a.m. in the morning, they still should have the same information and the same safety that what they're buying is what they're getting.
I love that, and with that, I think we'll wrap up. But we'll definitely have Ami back. We'll do some of these sort of Q&A live shows too soon again, and just keep in touch, and we'll do that. For now, Ami, what's the best way to reach you and follow you?
I'm at Ami Ben David on Twitter, and my email is ami@spicevc.com. If you have any you know, project you think I should see, you're more than welcome to see it. Anything, you know, in the space of the infrastructure for security token across the value chain is interesting to me.
Love it. Ami, thank you so much for coming. I really appreciate it. You will be a regular on here, so you're not off the hook. You'll be
Thank you.
Thanks.
Okay. Bye-bye.
Bye.